Chat with Traders, episode 117 is backed by Squarespace. Whether you need a website for your business, a web store to sell products, or something as simple as a blog to share your ideas, Squarespace is everything you need to make your next move. Start a free trial today at squarespace.com and use the coupon code TRADERS to get 10% off your first purchase. And if you go for the annual plan, you'll also get a free domain.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
Hey there, team. What's good? Welcome back once again. With me this week for episode 117 is trader Larry Alintoff. If the name rings a bell, then chances are you've seen the TV series Wall Street Warriors, where Larry was featured on season 2. Larry's had a long-lasting and impressive career as a trader. In his earlier years, he worked as a prop trader for Paul Tudor Jones. Later on, he ran the largest group of traders on the AMEX at the time. Then, when he went over to the New York Board of Trade, Larry became the largest trader in frozen concentrated orange juice. Nowadays, Larry is CIO of the Toro Fund. During this episode, we cover the thing which helped Larry to become consistent, why there's great opportunity in knowing when things that should happen don't happen, how he's been able to successfully apply a similar trading method from the floor to the screens, and how a market obsession has carried him this far. Please enjoy the interview, guys. Hit me up on Twitter if you have any thoughts at Chat with Traders. Here is my guest from the state of Florida, Larry Alintoff. Larry, what's going on, boss? How's your day been?
The day's been actually sort of interesting because the United States markets are really, really slow right now. The actual indexes aren't doing much, but tomorrow we have a Fed meeting. So we really spent the day trying to model what we think should happen tomorrow based on 3 different scenarios that the Fed might do. So basically, most of our day was dealing with that type of stuff, which we normally don't do, but we'll get into that. But today we actually did do it, and the markets are quiet and giving us a chance to do that. So, and there's some interesting stuff with that we'll get into.
Yeah, I definitely want to pick up on your mention there of modeling what you think may happen tomorrow. So let's circle back to that. To get this started, I know you've been trading for around about 30 years, which is a fair while. Where and how did you first get started, though?
Oh, Aaron, that is actually a great question, and it's a funny story. Believe it or not, on October 19th, 1987, I was at the University of Michigan, and I was eating lunch, and one of the guys that I was eating with had mentioned to the whole table, did anybody see what was going on in the stock market? And literally, I finished lunch, I went downstairs into the basement. I was totally by myself, and I put on what was then FNN, which is now CNBC, and sure and behold, the stock market was literally crashing, and it was down 20-something%. That moment that I sat there and watched TV, I was hooked and obsessed, and I've been that way, fortunately or unfortunately, for 30 years. And that's literally what got me totally involved in the markets, was that specific day.
So had you had any interest in the stock market at all prior to that event?
You know, I knew about the stock market, and I had watched some stuff, but I never really thought about it in terms of what it meant and in terms of, how to think about it properly and the correct way. And what's funny about that day was that I remember there were a couple of quote unquote gurus that, that claimed that they actually called for a crash. And when the crash came, all of a sudden, the entire media wanted to speak to them because now they were a guru and they could tell you what was going to happen. Well, I specifically remember one of them, and they were saying, well, now that the stock market crashed, we're going to go into this Great Depression. So I'm sitting there, I think it was my sophomore year of college, and I'm like, well, I guess if we go into a depression, I need to change my career. So at the time, I was getting a degree in finance. And I said, you know what, I better maybe do a dual degree so I won't have to worry about it if we're in a depression. And I actually went and became an accountant as well as a degree in finance. So I double degreed basically because of that day.
Okay. So how did you begin learning how to trade? I mean, we're probably skipping a short period of time here, but when you decided that you were going to start trading, how did that sort of come about? And how did you begin learning the stock market?
I totally started probably a little different than most people. I literally I got graph paper, a giant poster of graph paper, and I started plotting prices in my dorm room after the stock market crash. And I was watching gold and the S&Ps, and literally every single day I would track the high, low, and close, not knowing anything at all. And over a period of time, I started to notice what I call a pressure point, and whereby the market would either go up big or down big, and I was able to start to sense it before it happened. So I would see something, for example, in the S&P, and I would have a pretty good inclination that the next X days we're going to be strong to the upside or strong to the downside. So that's literally how I started. And after that, I did what probably most people do and go to the business library or the bookstore and get as many books on trading and people that traded as possible as you can get.
Okay, and these pressure points you refer to, is that something that you continued using sort of moving forward, or was that just sort of where you began to cut your teeth?
No, I did. I used those points in virtually every single market, mainly futures markets for the most part, but that's where I really started to put together a track record, and it was small, but it was consistent, and those pressure points completely existed, probably do today, but they were very, very clear back in the late 80s, early 90s. And a lot of people talk about there were some big trend followers back then, and the markets have obviously changed, and the markets always change. So for me, for the first X years, 7 years, 6 years, I was completely using that method that I had literally taught myself. And I could take the graph or the chart and I could turn it upside down and I could see it from the opposite way. And I would literally my mind just started to totally look at different patterns. And I could see patterns just from the open, high, low, close, like other people can. But I was doing it at such a young age that I was kind of getting in rhythm with the markets, if that makes sense.
Yeah. So what is a pressure point? Can you just kind of, I know it might be a little bit difficult to explain because we've only got audio here, but can you just give us a basic idea of what is a pressure point?
Yep. And it's very simple. It's basically what is known as, for example, an ascending triangle. It's it's basically technical terms, basic stuff like an ascending wedge or a triangle whereby the market's gone, or even a market that's gone completely sideways for a period of time, and you're literally looking for a breakout in either direction. And you can overlay that market with an indicator, for example, like a stochastic, and you can start to notice divergences on that chart where the stochastics today are higher than they were recently, but the market is making higher highs. And you can tell, and you can start to get a sense that if it breaks above a certain level, the market can really take off here.
Have you found those sort of things to become less reliable over time?
So I think what happened is they've certainly become, I don't want to say less reliable. They're reliable, but in the what I'll call the old days, a move from one of those pressure points could last weeks, if not months. And I think today, which is something that we definitely need to discuss, but the way that information works today, these moves can happen so quickly that it's literally incredible. What used to take 2 weeks or a week can literally happen in an hour now. So it's a little trickier because of that. And I think some of that has to do with the information flows that are going on.
When you say those moves can happen in the space of an hour, are you talking about like the same amount of range, or are you just talking about the actual move is over and done with a lot quicker?
Well, yeah, it's a combination of both. Right now in the stock market, for example, I'll use that as an example. We have these high frequency traders, and basically they're sniffing out order flow. And when orders come in to buy, oftentimes they're running in front of these guys, and they're moving the price up so rapidly and so quickly that in the old days when there was a specialist and the price would move a quarter at a time, it was a little different. You had more time to evaluate, to think, where today you don't have that time. If your order wasn't in, you could literally miss the move. It can happen that fast, and the models have to adjust. Now, that's not to say if we get some crazy supply-demand situation, the markets will trend. And the markets can trend, and they do trend. But the trends look and feel a little bit different than they do back in the 90s, if that makes sense.
Well, let's continue on the path of your journey as a trader, if you will. So I think the first actual job you got in markets, you worked at Refco. Can you tell us a little bit about that? I think that was a Forex broker, if I'm correct.
Yeah, they were at the time probably the largest foreign exchange broker. We competed with all the banks, Citigroup, Citibank, JP Morgan. And basically what I was doing was running a desk and actually learning how to be a market maker in foreign exchange and metals. And over the course of about 6-7 months, I picked it up pretty well, and I ended up running the desk. So I was actually running the overnight desk. So I had kind of interesting hours. I worked like 2 p.m. to midnight, New York time. But the experience that I got from there was just being, making a market and learning how to kind of get out, get in, get out, get in, get out, that kind of thing. And trying for the most part not to take too much risk. What was interesting was my boss at the time saw that I was able to, and I was using these pressure points again and watching the order flow in the markets. And my boss said, "You know what? We think you should trade for Refco. You should be have a line and trade." And I did. And I was fortunate, and I started to become very, very consistent in the markets. And one of the, I don't know if it was my boss or somebody else, and I don't know if you want to go into that story, but had brought my name up to a market wizard, basically. And I started managing money for one of the market wizards. And that's basically how I ended up going from Refco to working for basically Paul Tudor Jones. I jumped the gun.
That's awesome. Before we get into you meeting Paul Tudor Jones, which we're obviously going to spend a little bit of time on, I want to pick up on your mention there of becoming very consistent. How were you able to become very consistent? Can you relate that to anything? Was there anything you did which really helped you to get that consistency?
Yeah, I can. It's very, very interesting. There is a fabulous book called Reminiscences of a Stock Operator. And it's by Edwin LaFay. And it is an absolute classic. And I every one of my traders that have worked for me have read that book at least one time, if not more. In that book, there's one of the stories when the head trader, Larry Livingston, basically goes bankrupt, loses his money. He comes back with a stake, and he's only really can trade one thing and one time, and he has to be right. If he's wrong, he's basically completely done. If he's right, he'll get a bigger trading line and he can come back. And the thing is about that is that if you think about it, I kind of back then did the same thing. I would say I would wait for every single thing to line up before I made the trade. Everything. So I wouldn't just take good trades or what I thought were going to be a good trade. I would take great trades. And I would put the probability of being successful completely in my corner, if that makes sense. And instead of just throwing darts and being all over the place, that's kind of what I did, back in the beginning, is that I just superly made sure that everything lined up. And it's kind of modeled after what he was able to do or what he did in those books.
So I guess in some ways it was about being very strict and very disciplined in picking the sort of trades that aligned with your plan. Is that a fair statement?
Absolutely. Absolutely. And that is absolutely critical, to be have your game plan and be able to be extremely disciplined and not be influenced by, noise or something else. And that was a huge key for me. And I learned that really early on. And to this day, it's the same thing. And to be successful and to survive, you have to have the utmost discipline and, basically a rigorous game plan that is well thought out before the trade's put on.
All right, Larry, well, tell us about how you met Paul Tudor Jones. How did this come about?
So after a while working for Refco, I started to put together a fairly decent track record. It wasn't over the course of years. It was over the course of maybe 9 months, 8 months, something like that. But it was very, very consistent and it was very, very good. And I got introduced, not specifically to Paul, but somebody in the Tudor group, and I think they had started a program a year earlier or 2 years earlier, and they were, from my knowledge, they were picking approximately 20, 25 traders that they thought would be good, and they were going to allocate money to them, and those traders would basically trade piece of Paul's funds, if that makes sense.
Okay, and that's what you did?
Yeah, so I was accepted into the program, and literally I left Refco, and I started to trade. I started to trade for Tudor, yes.
Okay. And whereabouts were you trading? Were you trading from an office? Were you trading on the floor at that stage?
Yep. No, I was trading. I was trading off the exchange floor, and I had a little office over at the same firm. I had an office over at Refco, and that's basically where I was trading. And that's basically where I did my trading, and I continued to do the same thing. Very disciplined, watching the markets, looking at the markets, and picking my spots where I thought that momentum would carry the day, if that makes sense. I was still using, the basic technical stuff that I had taught myself that was working, fairly decently across all markets. It wasn't like it worked in one market and not somewhere else. It worked across the markets. It was the same human psychology that when it exists, it doesn't matter where it is, it exists.
And did you have much interaction or much to do with Paul during that time while you were trading his funds?
No. We were basically we had spoken to people within the group, and I can tell you a story about that, but we were basically had no guidance at all from Paul. We were completely separated from them, from what they were doing, and we existed basically on our own.
Okay, right. Yeah, I'd love to hear that story that you hinted at.
Well, sometimes things are Paul's known for being completely a genius, and he is. And I remember back in the old days, they used to have faxes instead of like emails and stuff like that. And I remember that one day I went over to the fax machine, and there was a piece of paper that came through the fax. And I had just was talking to one of the other traders that I think was also managing money for them. And lo and behold, it looked like it had a list of all of the traders' positions. And you started to put one and two together, and you could see, here was something that you're out trading for him, but you realize that the genius part of it is he's building a sentiment indicator or something to see where traders may lie. So, for example, if everybody was long cocoa and, somebody in their group would know that, that's valuable information. Because if we're all long, then maybe, a lot of other people are long. And it kind of dovetails with the end, what I call the end of those pressure points. And the market started to get a lot choppier towards the end of that. And I always wonder if it kind of runs amok between the two, if that makes sense. Everybody was trying to game something else.
Yeah. So he was trying to, when you describe it as a sentiment indicator, you're talking about amongst the traders who he had funded?
Yeah. So he had funded traders, and, obviously he keeps track, somebody in there was keeping track of everyone's positions, and it just gives really, really good information to, to an amazing trader, to somebody, a great trader. It just gives more and more information about what other people are doing in the markets, as opposed to what people say they're doing in the markets. These are what people are actually doing in the markets in their positions. So we probably weren't supposed to see that fact, but it was nonetheless, it was interesting. And for me, I was always, which started again in the 1987 when I was watching, I've always questioned things. I always ask why is something happening? Why is a market moving? What's going on? And, you question everything. So you start to see that, and it's just, it's like, wow, okay, you can get valuable information if you know what other people are doing. And it's ingenious and it works.
Yeah. And even though you didn't have a great deal or a great amount of interaction with Paul himself, obviously you were very familiar with who he was and the sort of level that he was trading at. Was there anything which you picked up or you noticed about him that really made him such a legendary trader?
Just the stories that, basically that everybody heard, starting down in the New York Board of Trade when he made some unbelievable trades in cotton, and obviously the stock market crash of 87. If memory recalls, I think he made like 25%. He called it. He had an analog model that matched up with it pretty well. But, for the most part, people that have existed for so long in trading, it's definitely cool to see not only how they evolve and what they do, but, how they do it and how they go about it. So no real dead secrets from what they're doing, but they're very, very good, obviously.
So you spent a bit of time trading Paul Tudor Jones, his funds. You then went on to trade the funds of another market wizard who will remain unnamed for now. But tell us a little bit about how that opportunity came about and what sort of things you were doing at sort of the next milestone in your career.
Yep. Well, that actually, the other market wizard came several years later. It is something that actually your viewers might find interesting with Paul. If you want to just go back for one quick second.
Yeah, sure.
So I think this was the third year of his program, and I had remembered speaking to the other traders that, and again, I was 22, 23 years old. At the end of the year, the successful ones not only got paid, but they were getting this, I think it was like $10,000 bonus. So obviously I was very, very excited. I had a decent year. And I remember I'm sitting home, living in New York City, struggling, rents are high, all like any other young 22-year-old would be thinking. And I remember getting this box in the mail. And it was a little white box. I think it came like, I don't know if it was FedEx or it was in the mail, but it was a really cool looking box. It happened to be from Paul Tudor Jones. And I opened up the box and it said, "Congratulations. Paul's making a donation in your name to his new charity that he's starting, known as the Robin Hood Foundation." So here I am, I'm 22, and I'm like, are you kidding me? like, I need the money. I needed that money. Looking back, obviously, it's the greatest charity in the world, unbelievable charity. And, but it's just funny because some things have a way, some things when you look back, like, they become major milestones. And for me, needing more money, for me, became a major milestone. And that box, literally, when I got that after that, I literally really, really thought about trading off floor. And I had a friend that was literally begging me every single day to come and join him. And he was working on the American Stock Exchange and trading stock options. And after that, I actually left and joined him on the American Stock Exchange, where we ran a huge group. And I know that you had one of the Blair Hull traders on that I think was doing it in the P Coast. And, but the American Stock Exchange, and I don't know if you want to talk about that, was a little bit different than the P Coast, but very, very interesting nonetheless. And for the next 5 or 6 years, I ended up trading on the American Stock Exchange and running the largest group down there at the time.
Okay. And what exactly were you trading on the floor there?
So we ended up having guys that were trading literally, we would put people in every single market, trading equity options, and completely different exchange. So it was the first time I was actually on a floor on an exchange, and the way it was set up was really interesting because you didn't have to think at all. The specialists would do all the thinking, and they were required to basically give 40 to 60% of any trade that came in out to the crowd that was helping to assist the specialist. So the guys in the ring didn't have to really do anything. They would just be handed trades. And it was interesting because it was very, 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 it was not so competitive, very, very, very easy to make money, not knowing what you're doing. And we had guys making just really ridiculous money, never asking how they're making it or anything. And just because the specialists would be giving them tickets and they would be getting trades that were basically guaranteed winners, if that makes sense, with very, very little risk. So obviously what we did is we went out and hired as many guys as we could, and we put them in all the different markets, all the different equities, and we basically ran a giant book because of that, and they were just down there. Some of them, did question what they were doing and tried to learn, but it's funny because out of the 50 guys that we had working for us, I think maybe one still trading today, which is interesting in and of itself, and the rest of them are gone.
Okay, the interview with Larry will continue in just one moment, guys. Right now, here's a brief word for our sponsors. So we've got Squarespace. Squarespace is everything you need to create a really nice website, whether that be a portfolio of your work, an online store, a web presence for your local business, or even a blog to share your thoughts, perhaps something like your trading thoughts. Creating a website with Squarespace is intuitive, and you certainly don't need to be a web design wizard. You have a wide range of award-winning templates to choose from. You can arrange content and features with a few clicks, and you never need to worry about running upgrades or installing things, etc. None of that hassle. To begin a free trial, go to squarespace.com and use the coupon code TRADERS. This will save you 10% on your first purchase, and you'll also get a free domain with the annual plan. Again, the coupon code is TRADERS, TRADERS. And again, supporting this episode is Proper Cloth. So if you dread buying dress shirts because you can never find the perfect fit, that no longer needs to be the case, thanks to Proper Cloth, the online custom shirt makers, highest rated on both Google and Yelp. With Proper Cloth, you can determine your ideal shirt size easily and quickly by answering just a few simple questions. You won't even need to pull out a tape measure. And best of all, Proper Cloth guarantee a perfect fit. You also have full control of how the shirt looks. So whether you want a crisp business shirt or a relaxed style for weekends, take your pick. There's more than 500 fabrics on offer. So ditch your shirts that don't fit, fix up, look sharp, go to propercloth.com/traders today, and during checkout, enter the coupon code TRADERS to save $20 on your first shirt. That link, one more time, guys, is propercloth.com/traders. So I mentioned before a market wizard who is the second one who will leave unnamed. Was that the trader who you joined on the floor?
No. So after the American Stock Exchange, things started to happen towards the end, and your other trader was talking about it basically on the Pecos, for example. On the old days, the American Stock Exchange had no competition whatsoever. So for a stock like Circus or IBM or Intel that was listed down there, there was no competition. So if somebody wanted to trade an Intel option, they would have to come down and see the specialist on the floor of the American Stock Exchange. The trade would occur, and that was it. What happened a couple years later, and this is the reason why a lot of these traders no longer existed, was all these other exchanges started to trade these same stocks that were traded on the American Stock Exchange. So all of a sudden, where the spreads or the bid and offer was a $0.25 wide or $0.50 wide, started to become an eighth wide or a dime wide. And all of a sudden, what was very, very easy no longer was easy. You actually had to start to think about what you were doing and why you were doing it. And that competition literally killed those floors. And the American Stock Exchange was no different. All of a sudden, we had the Boston Exchange, you had the Pecos, you had the CBOE, and all these other exchanges were listing, basically were breaking up the monopoly that the American Stock Exchange had. And if you didn't really know what you were doing and how you were doing it, you were kind of in a little bit of trouble. And for me, after X years with that, I ended up going over to what was then the New York Board of Trade. And on the New York Board of Trade, I ended up going into, believe it or not, the frozen concentrated orange juice pit. And I don't know if you ever saw the movie Trading Places, but it was very, very similar to that. So I ended up going to a completely different exchange where the rules were completely different than the American Stock Exchange rules. And this is the first time that I would say that there was basically real trading. This was complete open outcry trading. You had to be first, you had to be fast, you had to be the best price. And survival was basically, nobody was handing you anything. Survival was no guarantee. You actually had to be able to think, make complicated two-sided markets at times, and completely different puzzle, if that makes sense, than it was on the American Stock Exchange. And you also, Aaron, which is interesting, but you had to be very anticipatory, if that makes sense. You had to think about your position, not necessarily how it exists today, but how it would look tomorrow and a week from tomorrow, and try to figure out the best way to balance that position off. So it ended up being a completely different experience being on that floor.
Just so we don't leave any loose ends, Larry, I definitely want to speak to you about trading orange juice. But your involvement with the second market wizard who we referenced, what was the involvement there? Was that in relation to the frozen orange juice? I mean, just so that we can tie that off and keep moving. Yeah,
so basically after, the second market wizard comes into play a couple of years later after the floor. Not after the floor, towards the end of the New York Board of Trade. There was like a 3-year period where there was the second market wizard did not yet appear.
Okay.
Sure. That's why. Sorry, that's why I didn't bring that up yet.
Makes sense. So how did you get into trading frozen concentrated orange juice? I mean, it just seems like such a random thing to trade. I mean, I know it's a real commodity, but why is it a tradable commodity? Like, how widely is it actually used?
Well, it's not really widely used. Believe it or not, they use it in the prison population. That's usually what they were using it for. But the market at this time in orange juice was fairly crazy and fairly active. There were a lot of players, and there were some very, very large players, off floor that actually needed the market to hedge. There was no fresh orange juice market at the time, so they were using the frozen to basically hedge their fresh. And for us, it was great because there was tremendous order flow, tremendous things were going on there, and a real theme started to occur. And it had occurred for me throughout my entire trading experience, but it really started to become concrete on that floor. And the way I think about it is that, and they always say, when things that should happen do not happen, that is such a big information piece. There's so much noise on the trading floor. When you come onto the trading floor in the old days, there's just so much. It's so chaotic. If I brought you down there, or somebody came down there, you wouldn't realize you would just hear noise and screaming. But in that, some of that is very, very valuable information. And I think, and I know I'm getting random here, but I think that you're seeing it like today, where you have so much information and so much different data coming at everybody. It's very similar to the trading floor. It's very, very similar to the trading floor. And the best traders were able to figure out what true information is and what information will be impacted in the market versus what noise is. And too many people get carried away with noise. They'll see something on the tape or this or that versus what true information is. And the true information is what we are seeking to achieve and basically looking to model. And that is literally the biggest key.
So how are you able to differentiate between the two? I mean, I guess that's where it becomes really tricky, is actually differentiating what is noise and what's information or signal.
Yeah, and that really comes from a couple of things. It comes from, I'll give you an example. So we were down in orange juice and we were in the pit, and there were a bunch of order flow started to come into orange juice, and they were buying massive amounts of call options. Basically, they were making a quote unquote bullish bet on the future price of orange juice. And they were doing it in such a big way that the price of orange juice should have been moving up at this time. I think coming into the thing, we might have traded, for example, 1,000 options a day. During this 3-day period, we were trading 5,000 options a day, 6,000 options a day. So it was so extreme, and it was just straight out a call buying. Buy them. And the price of orange juice should have gone up. And all the guys, I don't know, how familiar we want to talk about options, but the guys in the pit, the floor traders that were making markets and selling these calls, had to buy futures to protect themselves. And the call buying was so fast and furious that everybody was raising their implied volatilities to protect themselves, and they were being forced to buy more and more futures. Well, that was all fine and dandy, and my partner made a great point. 2 days later, the futures price did not move at all. Completely didn't move. That bit of information was absolutely critical and huge. And I'll tell you this, a month later, orange juice lost 50% of its value. It absolutely got imploded. And Aaron, I see it today. So take that one little example of something that should have happened that didn't happen. And see it today. We see it. Sometimes you get exogenous call buying, for example, in a stock. Okay, we had one a couple weeks in Starbucks. We had it a couple weeks ago. They came in and they're buying massive amounts, abnormal amounts of call buying. Stock price doesn't move up. That's huge information. 2 weeks later, the price of Starbucks goes down pretty big, $6, $7. So it's being able to use huge information and the correct information. And the best information is actual impacted information. So these were people that were coming in and they were buying call options and they were putting their money down. And when things don't happen that should happen, that's when there's real money to be made, when the markets literally go the opposite way. And by the way, if you think about it, look at the election that we just had with Trump. Everybody said the market should be down and down big, and it should have been a bloodbath, etc. And when it wasn't, that's information. So it's basically, it's every single day, it's every trade, asking yourself what should happen and what did happen. And if you start to think along those lines, all of a sudden you start to see what's working, what doesn't work, and you could start to model sort of correctly, as opposed to modeling based on, okay, if a market, for example, closed lower 9 days ago, and and the RSI is above a certain level, we'll buy the market. I mean, that's just back testing stuff, where this is actual market information.
So in these couple examples you gave here, you said that the price should have gone up because there were so many people taking bullish bets and buying options. Why did the price not go up and barely move at all? Why not?
So what most likely happened was that smart money came in to buy those calls because in reality, they wanted to protect themselves. They wanted to short the futures and have, God forbid, protection if they were wrong, where the calls would basically stop them out. And they came in and they probably, for every call they bought, they would sell a future. So the futures were not moving up as they should have. And the Starbucks example was probably the same thing, where they came in and they buy thousands of upside calls. And you know what? The price isn't moving because they're shorting the stock. And they could be shorting the stock for any slew of reasons, but there's a probability that could be smart money, if that makes sense, or insiders or somebody that knows something that's going on. And not all the examples work like that, right? Sometimes they come in and they buy all the calls and the stock moves up. That's fine. That's what's supposed to happen. So it comes down to when something's happening that should not happen. That's what should pique your interest. And look at it that way. That's where real opportunities to make substantial amounts of money lie. When something doesn't happen and should happen.
And when you're talking about smart money and you're referring to other participants as they, who are you actually talking about in these examples? Like, I know you don't know specifically, but like a general idea, like who are you referring to here? So
like in the case of orange juice, there would be smart money would be considered somebody that's actually producing the orange juice crop, and they actually have oranges. They know, they have better information than anybody. They know, what the demand is. They know how much they're selling, and they know they can look out their window and see, how big their crop is. And orange juice is an interesting example because it's a very, very small market. And there's some people in there. Louis Dreyfus is the biggest player, and they basically control a lot of this crop. You wouldn't know if you're standing on a trading floor, who's, which order's coming in, who it is. But you look for certain patterns, and you look for how the market reacts to certain things. And, I know orange juice or the Starbucks example is just two small examples, but it's any way that information or data reacts to the actual impact and the price movement of the underlying and how and what should happen. There's no way, like you said, there's no way to always be able to tell what the smart money is or the dumb money, but you start to see patterns. And you can start to see when you watch news, for example, or different data, that some of it doesn't move the stock, and other times other information does. When we stood on the floor of the American Stock Exchange, if somebody bothered to pick their head up, there were times when there would be 50 brokers coming in to buy, calls or puts, or come in for a reason to buy a stock. Other days, nobody would be there. And I've always said, and we've always tried to model, well, why are brokers coming in today to buy this stock? And you backtrack. You say, okay, let's figure out why. Was it a technical point that came out in the market? Was it earnings? Was it some news? What was it that is impacting that price? And I say this because I want to say, as opposed to looking back and saying, okay, IBM went up 3 days in a row, so therefore the next day should be down. That kind of model, if that makes sense. The models that we look at here, what I'm doing now, and the models that we've developed deal with actual things that are happening, informational and data in the markets versus what should happen, if that makes sense.
Okay, it does make sense. It does make sense. So let's say you spot some of this activity, which seems kind of unusual. Mm-hmm. How do you actually plan a trade, and how do you actually trade based on that information? Like, how do you actually capitalize on what you've observed?
Well, in the case of the ones that we just spoke about, so you would we would basically let a little bit of time go by and see what happened. And we know when we model it that, X, Y, and Z should happen. In those two cases, in orange juice and Starbucks, for example, just to use those two and just to use this one form of information, because there's a lot of them out there. Just to use those two, over the next day or so, both of those prices should have moved higher. So orange juice and Starbucks. Both cases did not happen, and actually both started to go down. So that was the tip-off to a trade. Now, how you express that trade, that's really dependent on the risk tolerance that you have, whether you want to go short it, protect yourself with a call, or if you were long, you may be realizing you might want to get out because the probability has now changed in that marketplace. And, how basically you want to do it, you can short it or whatever. That's really up to the individual trader and how they do that. What we do here is we obviously, you have to have a point where, even if you have that information, you have to have a point where you're going to be wrong. And if you're wrong, you have to get out. And that's the key. And you're dealing with probabilities. And one of your Edward Thorpe, who you interviewed, who's amazing, talks about in the casinos how he would change his bet based on probability. When there was a lot of high cards, he would increase his bet. When there weren't, he would have a lower bet. It should almost be no different in the marketplace. When you have information that a price is not doing what it's supposed to do, after you look at thousands of cases, you start to develop a probability of an event likely happening. And if you can weight that probability, you can also weight your bet size so that you have a bigger bet size for a higher probability event occurring. Having said that, you'd still have a stop in place that if you were wrong. But no different than, what he was talking about on the casino if you were counting cards or something like that. So it's all about having a probability, and the way you get a probability is to have been able to go back and look at as many cases as possible as you can find. We've looked, just so you know, rough and dirty, over 80,000 cases. And with that, we are able to put together a fairly good probabilistic point of view as to what should happen in a market. And we can vary our bet sizes based on that information.
Now, you said that these sort of opportunities can lead to massive rewards. When you were trading frozen orange juice, how much would you say these opportunities made up your profit at the end of each year? Like, I don't know if you have any numbers on that, but just like a rough idea.
No, that's a great question. So we were in orange juice. I ended up becoming, my partner ended up becoming the largest traders in orange juice. And it's funny because there was a magazine called Trader Monthly, and I don't know if you're familiar with that or you ever heard of that, but it was actually a pretty famous magazine. They no longer exist, but they had called, I guess, randomly up to our clearinghouse, and they had asked if there was anybody that stands out that they should speak to, and they brought up my name, and they did a feature in Trader magazine on me and on orange juice, and that led to other opportunities, which I don't know if you want to get into, but in terms of your specific question, we were able to generate very large, very consistent profits. I would say that event that I told you about in orange juice might have occurred in that one specific market probably once or twice a year where something didn't happen that should have happened, and we were able to capitalize on it in a pretty big way. I would say that probably led to 20% of our profits from those events. And the other 80 was doing our thing, filling in the puzzles, being anticipatory, and, buttoning our positions and making, size markets. The beauty is you're on the trading floor and there's only, I'm trading in orange juice. I have one market where now, it's funny because you go off floor. I have 7,000 markets theoretically. We have 7,000 stocks that we can look at and apply the same edge that we were applying in orange juice and apply them to 7,000 different stocks. So it's kind of very, very interesting in a weird way, but all the building, you can't just come and say, okay, I'm going to trade, 5,000 stocks. You almost have to figure out what you're doing and then see if you can apply it towards many different things, if that makes sense. Being in orange juice for X years and then being on the AMEX and trading one or two stocks, kind of allowed me to see, well, why would this stock move today? Why were brokers in here today? What were they reacting to? What are they looking at? Why is something happening? And I think, that's a really important thing about being successful is to kind of ask yourself, the whys instead of just blindly doing something, if that makes sense.
Do you think it's important to always understand why a certain move is happening or why a stock's moving a certain way? Or do you just kind of need to be able to react to it?
It's a great question. It's a combination. My biggest issue was always taking profits too quickly and not letting it run long enough. Knowing why something is moving would allow that person to probably stay with the trade longer, if that makes sense. But in today's world, there's no way to you're not really ever going to know for certainty why something is moving. So it's kind of like a caveat. It's kind of like, it'd be great, but the reality is it's not going to happen. So the most important thing is to know when you're wrong and be able to be disciplined to get out of it and structure the trade in such a way that no one trade is going to really hurt you. And, to be able to put together a string of those trades where you have, 60% probability, 65% probability of making money, and you can put together 50 of those, each day or 20 of those each day when something is going on, and just to use that one example where it shouldn't be going on and you pick that up from 2 days of work before. Well, you start to build a portfolio of that yeah, you're going to have some losers, but you're going to have an awful lot of winners too. And you're not going to always know why or who's doing what. You're just going to, follow along, if that makes sense, and you're going to get in gear with the market. And I don't mean to keep using those two specific examples because there's tons of, different news that may move a market or may not move a market. And if you just sit and you ask yourself, what should happen and what is happening? And if it differs from what should happen, that's where the opportunity lies. So when Trump won, the market should have gone down, but it didn't. That told you something. So, how you play that accordingly, forgetting your views if you were bearish, but that's information. So if you have a list of things that you think should happen, when they don't happen, that is such valuable information, even from an individual point of view or trader, that you can totally take advantage of that and absolutely make money.
Yeah. I like how you keep emphasizing this point. I think it's really valuable, and I think you're doing a great job of explaining it to us. I think it's good that we keep referring back to the same examples as well, because it adds a lot of context. So, I appreciate that, man. That's awesome. So tell us a little bit about how you're trading today. I think you've probably already described it to a certain extent. Is there anything else which you're doing, working on? Give us the 1,000-foot view on how you're actually trading today, like your sort of universe, your time frame, that sort of thing.
Absolutely. So we have taken what we had on the trading floor and the observations that we have seen on the trading floor, and we have figured out a way to apply them to basically, we're trading equities now. So, and a lot of these equities trade like commodities. As you know, because we spoke about it earlier, these HFTs, the way they trade, they move in and out of markets so quickly. These stocks are moving around like commodities, but we have taken what we had, this quote unquote edge or alpha, and we have been able to apply it to 7,000 domestic stocks here in the United States. And we build portfolios every single day on long and short, and they all have a fundamental catalyst. So there's a reason why these stocks should go up and or down. And we build a balanced portfolio. So it's long short that's basically completely balanced, so that we're trying to capture, basically that VIG or that extra edge. And it's all based on short-term fundamentals that we can quantify. And we know from looking back, basically for 20 years or 15 years, and we can go back and look at, I think we looked at 86,000 different data points for these names and see how a fundamental change or a fundamental news would move an individual stock up or down over a very short period of time. And I bring up the HFTs because had you been running a portfolio like this in, let's just say, 15 years ago, your holding period on the portfolio might have been 2 weeks because stocks didn't move as fast as they do today. Well, today at our fund, we hold our portfolio for approximately 5 days. That's it. So our portfolio is completely turning over continually, and it's all based on stuff that we had spoken about earlier and how to identify that, but also other fundamental catalysts that diversifies that portfolio out.
Okay. Now, you mentioned that you've got 7,000 stocks in your universe. How many names would you be holding or a position in at any given time?
Great question. We approximately hold, I would say, 80 to 100 longs and 80 to 100 shorts at any given time. Out of the 7,000 stocks in the universe, and I mean all the different exchanges, you have to weed out for liquidity. So you're probably going to be left with, let's say, 5,000 stocks. Out of those 5,000 stocks, we probably get signals on 15 a day that, to be bought, and 15 a day to be sold. So out of thousands of stocks, there's only 15 a day that'll meet the very, very strict criteria that we are specifically looking for and trying to capitalize on. So it's yeah. And something, Aaron, which is crazy, but in the old days, there was no way to do it. Computing power today is so great. Our computers literally go through thousands of data points, and it can do it in literally a minute. And it can literally spit out to us the ones that we need to take a look at. So, and I don't know if you could have done that 10 years ago. I think it would have been very, very difficult.
Yeah, definitely much slower, that's for sure.
Yeah.
As you bring that up, and you're doing a lot of modeling now, and you're looking at such a wide universe of equities, has that required you to learn completely new skills, since coming off the floor, or have you just hired people to do this for you?
That's really a great question. I am not per se a programmer. So we have a small team of 4 different people in here, and one of them programs, but we've also used outside programming to do it. I am literally like complete old school. Like if you saw my desk, I have yellow pads on it. I write down notes. I think, I'm watching the markets and seeing what's going on versus what should be going on. And I take all of those ideas and then they get spun to the programmers, and then they write up stuff and we look at it. It's one of the things I wish I had the time to do, go back and learn how to program. But thankfully, the younger generation can do all that, and they do for me. It's great.
Nice. I just want to go back to a point and speak about it a little bit. Why do you want to run a long-short portfolio? What's the advantage of doing so?
The advantage for us is that, it was like, for us, we knew the floor was coming to an end, and everything was going electronic. And we had seen so many cases, and I saw it from the American Stock Exchange. We had 50 guys working for us, and nobody was able to kind of make the leap to the next level, or off the floor. And we had such really good observations throughout the 20 years of trading that we knew if we can apply what works on a trading floor, but figure it out to doing it off the floor, that it could be really, really interesting. And again, a lot of it comes down to, because instead of just trading one market, you can trade, X thousands of different markets. And for us, we kind of got lucky in a weird way that it all, that kind of all lined up, that these notes, the reasons why brokers were in there, the reasons why they were buying or reasons why they were selling, they didn't just wake up one morning and say, oh, I want to buy XYZ today. There's got to be a reason. There's a catalyst for it. And we were able to go back and figure out, we had what we call positive expectancy on the trading floor, where every time we did a trade, we mathematically can quantify how much we should make on the trade. Now, not every trade is going to be a winner, so it's over the course of time to figure out exactly mathematically what your edge is. And we were able to take that from the trading floor and bring it off the floor and mathematically quantify. Each time we do a trade, we know that over a course of time, we're going to make X, Y, or Z. With the losses, with the slippage, with the commissions, everything built in. And that's kind of cool to see. And for me, it all comes back to sitting down in that basement and literally watching the stock market crash that hooked me 30 years ago. And I'm still hooked to this day. And I remember, Aaron, every single Friday on the floor, I would be so depressed. I would leave the floor on Friday so depressed because there was no trading on the weekend. And I'd have to literally wait till Monday morning to get back there. And it's weird, but I feel like kind of the same way. So I wake up every single day just so excited. We're basically become obsessed, which is good and bad. But I basically, for 30 years, completely obsessed, about the whys and what's happening and why it's happening, and try to look at ways to make money.
And how key do you think your passion and your obsession, as you describe it, for trading has been to get you to where you are today?
I think that my personality, I think I never, it's like, it's weird. You see people sometimes give up. I will always keep coming back for more, if that makes sense. I'm always trying to learn, always trying to get better. And I think my personality completely fit into that motor, into that model. And always, like I'll go home at night and I'll spend an hour and a half and I'll go through the entire day. And I don't get lazy about it. It's almost like a workaholic kind of, background that I have. Like I just don't stop. My wife's not happy about it, but, and I think that's helped me.
Now, Larry, I want to ask you a question. So, someone like yourself who's been involved in trading for, around 30 years now, it's a long time. I think what I've done in the past when I've spoken to traders who have been trading for similar periods of time, I've asked them sort of like what things have changed over that period of time, what things have changed over the last 30 years. But I was having a conversation with Jeff Davis, who was on, I think he was originally on episode 70. Anyway, we were speaking and he sort of said to me, one of the things that's really important is what hasn't changed, what's stayed the same. So I'd like to ask you, over the 30 years that you've been trading, even with all the changes that have taken place, what are some of the things which have remained the same after all this time?
Yeah, that's great. It's great to look back and think about that. The reality is that it really, and I hate to say this because you're trying to, after 30 years, you want to say, wow, I'm so sophisticated and this, that. The reality is the human nature is not changing. Fear and greed, it's exactly the same. There's still elation when you're right and despair when you're wrong. That's not going to change, and that's never going to change. And the things that work, it's funny because a lot of things that work will continue to work as long as it's based on the right premise. And I think that's, and I know we came back to it, but I think that's just so important. And for me, like 30 years ago with pressure points and things like that, that's important. And that stuff still works today. Maybe the movement happens faster now where you'll make money faster and or if you're wrong, lose faster. But, you can adjust to that, right? All you have to do is lower your bet size down, lower your risk down, and you'll be in the same spot you were in. So, the old saying is the markets change, but the markets always change and the markets always stay the same. And I think the successful traders kind of come back to the bottom line is, why is it going up? A stock or a commodity or futures is going up today, probably for the same reasons it went up 5, 10, 15 years ago. There's a reason that for one day there are more buyers than sellers or vice versa. And that's just not going to change. And, you can go and people can go and model things like that. But the reality is it comes back to the basic human nature, fear and greed. And that's not going to change. And that book that I mentioned, Reminiscences of a Stock Operator, let me tell you, when you read that, it's just eye-opening because those stories are exactly the stories that you will have today from trading. And you sit there and look at it and you go, oh my God, this is 70 years ago. How can that be? They didn't have computers and things then. But you know what? They're exactly the same. And it's pretty cool. That's probably why I've been doing it so long because, like we said before, I'm not a programmer. So if it was all just programming now, I wouldn't exist. I wouldn't have been able to adapt to that. But it's not. And it does come down to, what's worked and observations. And for me, that's been completely key.
I really need to read that book. I know a lot of listeners are probably shocked right now. I've been saying it for a long time, but I've never read that book, and it just keeps coming up all the time. It's just the problem I have is there's so many books I want to read, and I'm not the fastest reader, so it's all about certain books taking priority. But I think I need to move this one up the list. Anyway, Larry, let's leave it at that for now. I know you don't have a great online presence. Is there anywhere listeners can go to find out more about you?
Yeah, you know what? It's funny that you mentioned that. One of the guys that works in the office, I've always really, really kept a low profile. And I did that for a whole bunch of reasons. My love is the markets. And I'm not on Facebook. I'm not on anything. I am on Twitter, and I am going to update all my stuff. It's going to be updated in the next 24 hours. I will get a social presence going, and there will be ways to get in touch with me. I have an email I can give you, and you can do that if that wants.
I mean, it's up to you. If anyone wants your email, just hit me up, and I'll share Larry's email with you. That's probably the better way to do it. But do you know what your Twitter handle might be?
I think it's the name Larry Alintoff, but I will. I'm on Twitter all the time, but I never reply. Not that I don't reply. I'm like a much better listener, if that makes sense. I'm always taking in information, and I'm often not sending out information. But it's under. I think it's Larry Alintoff or Larry.Alintoff, but I can definitely text you back or send it through the Skype. Yeah,
we'll work it out. We'll put a link to it in the show notes because I'm sure some of the people listening to this will be keen to follow you. So
I'm definitely on Twitter. So like if you put my name into the thing, it will come up.
Okay, cool. And I will also just mention you were on season 2 of Wall Street Warriors. All 10 episodes of that can be found on YouTube as well. So I'll also post a link to that in the show notes. Larry, thank you very much for coming on the podcast. It's been an absolute pleasure to have you on. Thank you once again.
I really appreciate it, Aaron. You're doing great work here.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.